This is the Alhambra Investments Weekly Market Pulse with Alhambra CEO Joe Calhoun. And Joe, I want to start off with some things. We had some extremes last week. On Wednesday, we got this really bad inflation report. Then we had really good news on retail sales on Friday. There are predictions out there about what the Fed's going to do the next time they meet. This is all very confusing for investors who would like to have some certainty in investing.
Yeah, it was quite the roller coaster last week. We still ended up closing down a little bit on the stock market, and commodities were down last week, which hurt us a little bit. But it was just a roller coaster ride because early in the week, at one point at the low on Thursday morning, I think we were down about 4.5% on the S&P for the week. We ended up closing down a fraction of a percent, so that tells you how much of a rally you got from that low Thursday morning. But yeah, I mean, look, the inflation numbers were not good on Wednesday. They were hotter than expected. And immediately people start thinking, whoa, they're going to go, Fed's going to go 100 basis points. They're going to go 100 basis points instead of 75. And I don't know why people just get so, they overreact to this stuff. Anyway, then we got a report on PPI on Thursday, which was also a little hot too. I think a little bit better than the CPI report. What I find interesting is what people focus on. We also got import and export prices on Thursday, or was it Friday? I forget. And they were actually quite good, but nobody paid any attention to that. So I'm not sure exactly why they ignore those things. I think they're pretty important. But anyway, yeah, it was a wild week. Everybody wants to know exactly what's going to happen in the future. And I'm sorry, but you can't have that. You just can't do it. And I would just say that if you go from report to report to report, thinking that there's something useful in every one of them, then you're going to be on that roller coaster ride, that emotional roller coaster ride, your entire investing career. And it's just not a way to live. There's a better way to do this.
Well, I found it interesting. One thing that you wrote this week when you said the Federal Reserve panics just like the average investor.
I think people forget sometimes. The same thing with, I mentioned something too about, company outlooks. But I mean, look, people forget, but the Fed, they're just people, okay, they're, accomplished people, I suppose, in some ways. A lot of economists there. Of course, Jerome Powell is not an economist. He's not, I think, a lawyer. But yeah, they're just people, and they panic in the same way that everybody else does. And so they're not this, this board of gods or something who can look down with no emotion and do the right thing. They don't even know what the right thing is, quite frankly. But I just find it interesting. I mean, they panicked, I think, in that last FOMC meeting when they went 75 basis points, when they had told everybody they were going to go 50. And they got panicked about that University of Michigan Consumer Sentiment Poll, the inflation expectations jumping up to 3.3. And of course, we got another report on that on last Friday, and now that number's down to 2.8. And it's like, so they panicked over something that really wasn't even real. So why they were concentrating on that poll, I really have no idea. It's just it's a sentiment poll. And it's a fairly small sample size. It's very skewed politically. Why would they concentrate on that? I have no idea. But yeah, they're just people, and it's the same thing with. I hear people saying, well, this earnings season, the important thing is not the numbers for the second quarter, but the outlook for the rest of the year. Well, I'm sorry, but the CFO of GE or whoever, they're just regular people too. They're subject to the same biases and the same influences that all the rest of us are. They don't know any more about the future than we do. They may have some insight about their company that you don't have, but they're not going to let you in on that, by the way. If it's some kind of valuable inside information, but their outlook for the rest of the year doesn't mean anything more than my outlook for the rest of the year. I don't know what it's going to do.
Well, there's this disconnect between the head and the heart. I mean, from a head standpoint, we know there's nothing certain, but from a heart standpoint, everybody's looking for that thing that is certain. So, of all those economic reports out there, most of which you refer to as noise.
Yeah.
What are ones that are helpful and still work?
Well, some of them are helpful in different ways. I'll just say this. Look, I'm working on a report right now, a paper, whatever you want to call it, that highlights all these things that we've found over the years that actually do provide some forward guidance, to use a Fed term. Things that actually do work to help us identify when a recession is going to start, when it's going to end, that kind of thing. I'll give you a couple of things to watch, a couple of things that I've found over the years. And these are not necessarily things that other people are looking at. And I highlighted a couple of them a few weeks ago in one of my reports. One of them is new entrants and re-entrants to the workforce. People concentrate on that headline jobs number every month. That headline jobs number is useless. Really, quite frankly, the only thing that matters about that number is whether it's got a plus or a minus in front of it. If it's got a plus in front of it, it's good. And if it's got a minus, it's negative. And oh, by the way, it gets revised in big ways. We've seen in the past where numbers that came out negative initially were eventually revised to be quite positive. So focusing on that number is a waste of time. However, there is part of that report, they have what are called re-entrants and new entrants to the workforce. And these new entrants and re-entrants to the workforce, that's a very interesting concept if you think about it. If the economy is bad, people are not rushing to come back to work because they know there's no jobs out there. But if re-entrants and new entrants to the workforce are still rising, that means that the labor market is pretty strong. And if the labor market is pretty strong or strong enough to draw people in, yeah, you're not in recession. And normally we see that number start to fall well in advance of recession. 6 months to a year before recession, that number starts to fall. It's done that before every recession, except for the COVID recession, which of course was a little bit kind of out of the blue, so to speak. It wasn't, you didn't have the normal lead up to that recession as you do others. So I think a number like that, that's something that's really interesting. I'll give you one on the other direction too. And it's one that people focus on for the wrong reasons. ISM manufacturing and ISM non-manufacturing. Those numbers, it's a diffusion index. So above 50 is positive, below 50 is negative. And so you see this all the time. Oh, the number dipped below 50 on one of them, whichever one it happens to be. Oh my gosh, we're headed for recession. Well, actually, that's not what that means. Under 50 does mean that you're slowing, but it doesn't mean you're headed for recession. In fact, you get numerous reports on ISM that are less than 50, and most of them don't lead to recession. However, if you get that number way down low, under 45, then you probably are in recession. And if you get down close to 40, that's probably the low. Things can only get so bad before they start to rebound. So ISM, don't pay any attention to it when it's high, and don't even really pay any attention to it even if it dips below 50, but pay a lot of attention to it if it gets down in the low 40s, because you're probably close to a low.
Let's wrap up today with a quote from this week's report. I thought this was a great reminder. You said, concentrate on what you can control. Your portfolio is not a series of bets. The elements of your portfolio, from stocks to real estate to commodities to bonds, are investments in the future, and future returns depend on what you pay today.
Yeah, I've been kind of thinking about this a lot. We have in our society normalized gambling. And where gambling is a fully socially acceptable activity these days. When I was growing up, gambling was not something that you did in the open. It was something that happened in the shadows, unless you went to Vegas, of course. But the bottom line is that now you can bet on anything, from sports to whatever. And I think that has bled over into investing, where people are making bets. That's the way they think of it. But that's not what this is all about. When we buy a stock, it's not just a bet on that stock price. What you're buying is a piece of the company. You're buying part of a company, and you're making an investment in that company that you expect to return on. So what you pay for today, the valuation that you pay, is going to affect that long-term return. How that company develops over the years, how its business plan works, how it is able to turn profit, and how it's able to return that profit to you as an investor. All that's the important stuff. The idea that you're just making a bet on up or down, to me, diminishes what we do. Think about this as investing. It still is investing. It's not just making a series of bets.